Most people hear interest rates up and think, sell the buildings, REITs are doomed. That's the headline. The truth? Not even close. Some REITs wobble, some crumble, and some actually get stronger, like a turtle with a steel shell. Stick around for the next 10 minutes and you'll get a simple roadmap for REITs in a high-rate world, 3 easy checks to use on any REIT, 5 oh no red flags, and the one metric I look at before I even think about buying. Plus, a quick trick to turn scary market days into buying opportunities. Let's go. Okay, quick and simple. What's a REIT? A REIT is a company that owns property. Apartments, warehouses, data centers, cell towers, stores. They collect rent and pass most of that cash to shareholders as dividends. What about a mortgage REIT? Different animal. They own loans and make money from interest spreads. When rates jump, mortgage REITs feel it fast. Equity REITs feel pressure too, but the result depends on 3 plain, everyday things: how much they owe, how good their leases are, and whether they actually generate steady cash. Think of it like a road trip. Some cars have good brakes, full tanks, and a GPS. Other cars have duct-taped engines and a prayer. In a storm of rising rates, you want the car that keeps going. Here are the 3 simple checks. The stuff you can do in 5 minutes without a finance degree. Write these down or tattoo them on a post-it. They matter. Check 1. Debt. Who's got a manageable loan? Ask, does this REIT have a lot of debt that changes with interest rates, or is most of its debt locked in at fixed rates? Fixed-rate debt is like a mortgage with a steady payment. Boring but safe. Floating-rate debt is like driving with a foot on the gas and no cruise control. Exciting until the bill arrives. If more than half the debt is floating, that's riskier during a rate spike. Also look for a clear plan. Do they show when loans come due? If they hide that info, be suspicious. Check 2. Leases. Can rents actually go up? Some tenants sign long-term deals with scheduled rent bumps, like a gym anchor that pays the same landlord for years. Others have month-to-month leases and can leave if things get ugly. REITs that own data centers, cell towers, or industrial warehouses often have longer, more stable contracts. That's good. Retail malls filled with tiny stores? Less good, unless it's grocery anchored, then surprisingly resilient. Check 3. Real cash in the bank. Do they cover the dividend? REITs report what they actually make. That's the number to watch, not their shiny headline yield. If a REIT pays out almost everything it makes with nothing left for repairs, that dividend looks risky. You want a cushion. If you wouldn't trust the company to replace a broken roof, don't trust the dividend. Alright, those are the checks. Now let's talk winners and losers. Quick, no PhD needed. So what does well? Data centers and cell towers. People and companies keep using more data every year. Contracts are long, customers are sticky, and rent increases are often baked in. Industrial and logistics. E-commerce isn't going away. Warehouses are business real estate gold. Certain housing REITs with strong demand and the ability to raise rents reasonably. So what REITs are at risk? Mortgage REITs. They live and die by interest spreads. High-end malls with lots of empty storefronts or short-term leases. Any REIT loaded with floating-rate loans and no visible hedging plan. Now let's make this practical. 5 red flags that should make you pause and maybe hit snooze on buying. Red flag 1. A big wall of debt maturing soon and no clear plan. If lots of loans are due in the next year and they haven't explained how they'll refinance, that's like finding an overdue parking ticket after buying the car. Red flag 2. Dividends that eat the whole paycheck. If a REIT pays out nearly everything it earns and keeps doing it by cutting maintenance or selling assets, the dividend could be unsustainable. Red flag 3. Short leases with no inflation protection. Short-term leases mean cash can drop quickly, and inflation eats margins unless leases adjust for it. Red flag 4. Shrinking occupancy, in a sector that should be stable. If a data center REIT keeps losing customers, that's a major smell test. It suggests pricing power is gone. Red flag 5. Vague answers from management. If the company's earnings call feels like a magician dodging questions, especially about debt and hedging, be wary. Okay, how do you actually use this in real life? A few behavior rules that are easy to follow. Number 1. Don't buy just because the yield looks huge. A 7% yield can be a lure. Ask, why is it 7%? Number 2. Diversify. Don't put all your REIT money into one property type. Spread it across sectors, or use a decent REIT ETF as your core. Number 3. Dollar cost average. Buy a little over time. Rates create volatility, and volatility creates bargains. Number 4. Prefer transparency. If a company shows a clear debt schedule, quarter by quarter, that's a sign they mean business. Here's a little script you can drop into an earnings call or email to investor relations. Ask this and you'll learn a lot fast. Can you walk me through your debt maturity schedule, how much is fixed versus floating, and how you're using hedges to manage interest costs over the next 2 years? If they give you numbers, clear dates, and a plan, good. If they answer with fluff, be cautious. Now, the cheat code. You asked for the single metric I watch before I hit buy. No Excel gymnastics. No nerd speak. It's this: forward interest coverage. In plain English, can the company still pay interest on its loans if rates stay higher and rents drop a bit? If the answer looks comfortable, great. If not, don't buy. It's that simple. Think of it as the REIT's ability to breathe if the air gets thin. Let's walk through a quick mental example. No tickers, just thinking. Picture 2 REITs. REIT A owns shiny data centers, has long contracts with annual price bumps, and most of its loans are fixed rate, maturing slowly. REIT B owns short-term rental offices, lots of floating rate debt, and pays a massive dividend that eats nearly all its profit. In a higher rate world, REIT A is like a long-haul truck with a full tank and cruise control. REIT B is a scooter with a hole in the gas tank. Which would you trust for a road trip? Exactly. Short and sweet. REIT dividends often get taxed as ordinary income, not the lower tax rate for qualified dividends. If you're in a taxable account, that affects your return. In an IRA or 401k, not an issue. Start with a diversified REIT ETF for the core of your position. Add small individual names only if they pass the 3 checks. Keep an eye on management transparency and the debt schedule. Use dollar cost averaging to ease into positions on volatile days. Last behavioral point: be picky, not greedy. Market noise makes people chase yield and ignore safety. The best investors aren't addicted to high yield, they're addicted to steady, durable cash flow. Quick recap, so you don't have to scribble notes. 1. Check debt, fixed versus floating and maturity timing. 2. Check leases, long and inflation-linked is good. 3. Check real cash flow, does it cover the dividend with room to spare? 4. Look for transparency from management. 5. If you see any of the 5 red flags, step back. If you want weekly REIT breakdowns, a simple spreadsheet to stress test dividends, and easy-to-follow picks explained in plain language, that's what 7 Hills Equities is for. Hit like if this made REITs less scary, and share if a friend needs to stop panicking about interest rates. Alright, time to close. Remember, high interest rates don't automatically kill good real estate, they expose bad business models. Find the REITs with steady contracts, sensible debt, and clear reporting, and treat headline yields like a curiosity, not a call to action.